Welcome to the Deep Dive. We're here to cut through the noise, pull out the key insights, and keep you really well informed.
That's the goal.
And today, we are doing a deep dive into Walmart's recent Q2 earnings call for fiscal 26.
A really significant one, actually.
Definitely. Our mission here is to unpack the financials, the strategy, the outlook, basically everything that emerged, so you get a clear picture of what's truly important for, well, the retail giant.
Let's get into it.
Okay, so let's unpack this straight away. Walmart's Q2. It certainly presented some mixed numbers, kind of caught the market's attention. We saw some, undeniably strong revenue figures actually beat expectations.
Yeah, revenue was impressive. $177.4 billion.
Right.
Which, like you said, beat consensus by a pretty good margin. And it grew 4.8% year over year, 5.6% in constant currency.
So a top-line success, no doubt.
Absolutely. Driven by robust sales pretty much across the board. It really signals, their underlying strength, even with consumers maybe feeling a bit pressured.
But then you look the profit side.
Yeah.
And that's where things got, well, a bit tricky.
Yeah.
Adjusted EPS landed at 68 cents, missed the street's estimate, which was around 73 cents.
That's a noticeable miss.
And operating income took a significant hit, down 8.2% year over year reported, though it was slightly up 0.4% on an adjusted constant currency basis. Still, quite a contrast to that revenue strength.
It really is. And the main driver for that pressure, the big one, was an additional $450 million in accruals.
For what exactly?
Self-insured general liability and workers' comp claims.
Yeah.
I mean, to put that number in perspective,
Sure.
that single item represented a massive 560 basis point headwind. That's 5.6 percentage points dragging down adjusted operating income growth just for the quarter.
Wow. Okay. Imagine trying to hit profit targets with that kind of unexpected costs landing on you.
Exactly. And tariffs played a role too, adding a bit more pressure on the profit side.
So we've got this really interesting picture, powerhouse sales performance, but these unexpectedly heavy profit challenges, a real mixed bag, like we said.
Yeah.
And it definitely got the market's attention, leading to that negative reaction, even with those strong sales.
Right. So let's peel back the layers now. Let's understand the forces driving both that great top line and those headwinds.
Okay.
Sales first.
Yeah. On the sales front, Walmart U.S. comparable sales, excluding fuel, saw a really solid 4.6% increase.
And that wasn't just a blip.
No, it showed consistent strength through the whole quarter. So, strong consumer demand, effective merchandising. What's really compelling is that general merchandise sales were positive across all segments.
Not just groceries then.
No, led by apparel, media, and gaming, and automotive.
Right.
It really highlights their broad appeal, capturing spending beyond just the essential.
And the digital side, that continues to be a huge story for them.
Oh, absolutely massive. Global e-commerce sales surged an impressive 25%.
25%.
With the U.S. leading the way at 26%. But maybe even more striking, global advertising revenue, now including Vizio, that skyrocketed 46%.
46%. Wow. In Walmart Connect in the U.S., even excluding Vizio, was up more than 30%.
So this isn't just incremental growth. This feels like a fundamental shift in their business mix.
Exactly. Towards these higher margin revenue streams. It diversifies their income away from just traditional retail. Think of it like Walmart's building new engines for growth.
Makes sense.
And membership income also saw strong growth, 15.3% globally. Sam's Club up a healthy 7.6%, and Walmart Plus showed double-digit growth.
So those subscription models are paying off.
Yeah, and what's fascinating is how these higher margin streams are increasingly influencing the overall operating income picture. They provide a kind of strategic hedge against cost pressures elsewhere.
Okay, so one hand, incredible top-line momentum, these new high-margin streams firing. Yet the other hand, those self-insured claims, the tariffs, created undeniable pressure on the bottom line. So how did management talk about this on the call? Did they sound worried?
They were quite clear, quite confident, actually. Yeah. They basically said, look, these unexpected costs hit the quarter, hit the year-to-date results hard, yes, but they do not alter the full-year outlook or the long-term view.
So they're sticking to their guns on guidance.
They actually reiterated the full year. It's pretty bold.
What does that imply?
It means they expect to fully absorb that, $730 million in extra expenses from the first half. Plus, they know there's continued inflation in claims costs coming in Q3 and Q4.
So they're baking that in and still holding the line.
Right. They believe the underlying structural margins are still improving, and they expect to get back to operating income growth consistent with their sort of multi-year trend, especially as the cost environment for goods stabilizes. They see these as temporary hiccups, not a fundamental problem.
Interesting. It sounds like they're really leaning on their long-term strategic plays to ride out these short-term hits.
That seems to be the message.
So, okay, what does this mean for those initiatives? They talk a lot about the omnichannel flywheel, big investments in AI. How's that progressing?
Well, the omnichannel flywheel is definitely gaining serious traction.
Like how? Any examples?
Yeah, store-fulfilled delivery grew nearly 50%. 50.
That's huge.
And get this. About a third of expedited orders arrive in 3 hours or less. And 20%, 1 in 5, arrive in 30 minutes or less.
30 minutes from Walmart.
They expect dynamic delivery windows to cover 95% of U.S. households by year end. They're really leveraging that huge physical footprint, turning stores into mini distribution hubs, speed, convenience.
And the marketplace is expanding too, I gather.
Yeah, global sales up 17%. And roughly 44% of those volumes are now flowing through Walmart fulfillment services. So they're handling the logistics for sellers too.
We also heard about that new Who Knew ad campaign they launched.
Right, in mid-June, highlighting the broad selection, the delivery capabilities, clearly trying to shift perception beyond just being the place for cheap groceries.
Okay, and AI. That's the other big buzzword.
And here's where it gets really interesting. Strategically, they announced a pretty significant structural change. Hired Daniel Danker.
The name sounds familiar.
Yeah, he's got deep expertise from Instacart, from Uber. He's now leading AI acceleration, product management, design, tech prioritization, and reporting directly to the CEO.
Wow, that's a big signal. Directly to the CEO.
And there's a new role for AI platforms too, reporting to the CTO. It just screams serious top-level commitment, embedding AI everywhere.
And they're building stuff too, right? Not just hiring.
They're actively developing these super agents.
Yeah.
Like Sparky.
The Sparky.
They're customer-facing AI assistant. The aim is to transform search into intelligent AI-powered assistants for discovery, shopping, reorders, returns.
And internal stuff too.
Yep, building internal AI agents for associates, for suppliers, even developers to boost efficiency, innovation across the whole company. It really sounds like a complete AI overhaul in progress.
Yeah. Management admitted AI isn't directly, lifting sales numbers yet, but they are, quote, biased towards growth with AI.
Meaning they see tons of opportunities for productivity gains, like using digital twins to predict issues in their facilities before they happen. It's not just talk. They think it'll fundamentally change how they operate. Better for customers, better for associates, more efficient.
Okay, one thing worth circling back to is pricing, especially with those tariffs pressures.
Right.
They're implementing something like 7,400 price rollbacks.
Yeah, about 2,000 more than last quarter. And grocery rollbacks are up 30% year over year.
So they're really leaning hard into that value message.
Exactly. Managing the impact on customers, especially those middle and lower income households, really feeling inflation. That's almost psychological, right? Reminding everyone, we are the value leader.
And inventory, with tariffs expected to bite more later.
They described inventory as being in good shape, at healthy level. They said much of the increase was actually goods in transit, not sitting piled up in stores. Suggests pretty good management, no major glut.
Okay, good. Lastly, let's quickly touch on international. Often gets overlooked.
It shouldn't. International sales grew over 10% in constant currency. Strong performance in China, Walmex, Flipkart in India.
And they're tailoring the approach.
Very much so. Expanding cloud formats in China. Developing these 300-minute FC's fulfillment centers and MFC's micro-fulfillment centers in India. That's for quick commerce, that ultra-fast delivery demand.
Or adapting locally.
Right. And rolling out the Walmart commerce platform in Canada and Mexico. That's led to a 75% jump in sellers, 40 million more SKUs, individual products.
Wow.
And crucially, they expect international profitability to grow faster than sales, boosting the overall company ROI.
Okay, so pulling all these threads together, what does it mean for the future? What's the guidance? Next quarter, full year.
Okay, so for Q3 fiscal 26, they expect net sales growth between 3.75% and 4.75% constant currency.
Very solid.
And operating income growth of 3.0% to 6.0%, again, constant currency. Adjusted EPS projected between 58 cents and 60 cents. So steady projections.
And for the full year, did those Q2 hits change things?
Actually, they raised their full year guidance.
Raised it, even after the profit miss.
Yep. Net sales guidance up to 3.75% to 4.75% constant currency. Adjusted EPS now guided to $2.52 to $2.62. And that's even with an expected currency headwind.
That shows some real confidence, especially after absorbing those big unexpected costs in Q2.
And here's the kicker. The adjusted operating income growth guidance, unchanged, still 3.5% to 5.5% for constant currency.
So that really underlines their confidence, right? That they can absorb the claims costs, handle tariffs, and still hit their profit targets.
Exactly. It reinforces that long-term goal.
Yeah.
Grow operating income faster than sales, that whole two P&Ls model they talk about.
Explain that again quickly, the two P&Ls.
Sure. Think of it like Walmart running two distinct financial engines side by side. There's the traditional massive retail P&L from the physical stores, huge, but maybe lower margin growth.
Right, the core business.
And then there's this second, rapidly growing, often higher margin digital P&L, driven by e-commerce, advertising, memberships. Management believes the growth and profitability in that second P&L will increasingly pull up the entire company's results.
Got it. So what's really striking here is this divergence, maybe. The market seems focused on the short-term profit stuff, the unexpected costs, while management is just hammering home the structural tailwinds. Advertising, e-com, membership, that's where they see the long-term value.
Yeah, and they sounded positive about the holidays too. Said back-to-school performance was strong, a good indicator.
Okay, this is the deep dive, and just a reminder, this next bit is not financial advice. Definitely not. It's just a thought experiment for the curious. Looking at what an outrageous but plausible trade idea might look like based purely on what we just discussed. Pushing the boundaries a bit.
Okay, well, considering Walmart's really significant commitment to AI, I mean, the strategic hires, the super agents like Sparky being developed, you could argue the market is just drastically underestimating the long-term potential there.
Right.
The margin expansion, the efficiency gains across their massive operations that AI could unlock.
So the AI focus isn't just talk, it's fundamental.
That's the argument. It's potentially a fundamental shift in how they operate, how they serve customers, impacting everything from supply chain right through to personalized shopping.
Okay, so what's the outrageous but plausible trade idea then?
It could be something like buying long-dated, deep-in-the-money call options on Walmart.
Long-dated meaning?
Like looking out to a 2027 or maybe even 2028 expiry, with a strike price well below where the stock is now.
And the thinking behind that?
The core idea is you're betting on Walmart's transformation, not just as a retailer, but into this tech-enabled omnichannel powerhouse.
With AI as the catalyst.
Exactly. With AI as a key driver that could significantly re-rate its valuation multiple over several years, you're looking for gains far beyond just, incremental sales growth.
So betting on a fundamental change in how the market sees and values this huge company, not just the next quarter's numbers.
Precisely. That's the outrageous but plausible angle, betting on that deep transformation.
All right. Well, that certainly concludes our deep dive into Walmart's Q2 FY26 earnings.
Quite a bit to unpack there.
For sure. We've seen a company showing really robust top-line momentum, particularly in digital and advertising.
Yep.
While battling through some definite near-term unexpected profit headwinds from those claims and tariffs.
I think the key takeaway really is management's unwavering confidence. In the long-term strategy, that two P&Ls model, and these aggressive investments in AI and omnichannel.
Their aim seems crystal clear.
Yeah. Get profit growth to consistently outpace sales growth, regardless of some of this short-term noise.
So as you reflect on all this, here's maybe a final provocative thought to chew on. Can Walmart's unique mix, that massive physical footprint, the rapidly scaling digital side, and this aggressive AI integration, can it truly set a new standard for retail?
Forcing a reevaluation.
Yeah, forcing a fundamental reevaluation of how we value even the biggest, most established companies in today's economy. What really stands out to you when you think about this retail giant's future path?
Something to consider.
We definitely encourage you to keep exploring these topics. Thanks for tuning in to Vid Dive.